Hey everyone, welcome back to the Commercial Real Estate Library Podcast. I'm Dayma and you know my co-host Garret McGillivray, and joining us today is the Chief Investment Officer of RioCan, Andrew Duncan. Thanks for joining us.
Thanks for having me, guys. Big fan of the show.
Oh yeah?
Yeah, I've been even before you guys asked me, I've been listening to a few of the podcasts. It's great stuff.
Love it. We've been on a heater recently. We had we haven't aired all these episodes, but we had on Blair Welch. We had on Michael Waters.
I listened to Blair Welch. It's out there.
Yeah.
I listened to it. I was telling Garret before we started, I've listened to 4 or 5 of the recent ones. So you guys have had some really interesting content. Stuff that's really relevant.
Can you just give us a broad overview of RioCan? You guys are a retail powerhouse, development powerhouse, more so retail, but you guys are one of the largest REITs in Canada, super successful. You guys have been around forever. Tell us a little bit about what's going on so that people understand the scale, the properties that you own, the millions and millions of square feet, and what you guys are up to.
Like you said, Chief Investment Officer at RioCan. RioCan is a real estate investment trust, and in my biased opinion, the best one out there. Been around for 30 plus years, established by our founder, Ed Sunshine, who's now our chair of the board. John Gitlin is our CEO. We own 177 properties across the country, in and around 32 million square feet, mostly almost exclusively retail focused. A little bit of office in there because it's attached to mixed use sites.
Yeah.
Some residential, purpose-built residential, which we're in the process of monetizing, but retail focused. 60% of that's grocery anchored retail, which is the hottest and best asset class in the market right now. Lucky for us, it's about time. I'd say we're the best in the business, right? Leasing operations, we've got a breadth across the major 6 markets in Canada. 60% of our rent comes from GTA, or 57 or something like that. So very focused on primary markets, very focused on grocery anchored. Us and, some of our colleagues, but I think us have the best relationships with tenants in the business. We know what's going on. We know what rent is, and we can deliver for our tenants. So
you guys
wise, we're the best in business. Now, some would argue with me, but I think that's what we're.
I think that's true. I mean, like anybody who's in retail, you're the first call, right? So whether you're selling something, whether you're no matter what you're doing in retail, you guys are known as the number one group. So that's my opinion.
We take a lot of pride in it. And
yeah.
We work our butts off at it. We've got a great team that focuses on it heavily.
So I'd like to bring the audience up to speed a little bit because retail is in vogue now. Everybody loves retail. Colin Lynch was on the podcast earlier this week. He's talking about how it's the best performing asset in the last few years. It wasn't always like that. Particularly during COVID, there was a big question mark of what's going to happen. And then we saw what happened. But can you take us through, say, the last 3 to 4 years of where it was and then bring us to today?
So maybe I'll go a little bit past that. So I'll go to COVID.
Yeah.
Right. So, listen, even a little bbit before COVID, there was a lot of conjecture in the retail market as an asset class saying, is this going to last? Is the online stuff going to get rid of retail? So for us, that was fake news, right? At the end of the day, our retail portfolio has performed throughout that narrative. And then through COVID, where we were able to stay open in the majority of our centers because they were all grocery anchored or necessity based. And then through that process, to be honest, the demand increased, right? The fundamentals of retail in Canada that have continued to improve are, maybe I'll give you a couple sound bites at the end of the day, and I'll quote some of our Q1 numbers because I can't say Q2 because we're looking at the MDA. And anyway, right. I'll quote Q1 numbers. So our average rent in our portfolio is around $22, $22.60, right? Our renewal, when we're renewing leases right now, it's on average just above 30. So there's an embedded $7.50 to $8 growth in our rents across our portfolio.
Right.
So that's a pretty good investment thesis, right? To build retail in Canada right now is around $600 a square foot.
Wow. Okay.
Yeah. Land in, carry in, all that kind of stuff, right? What it's valued, what you pay for it, whether it's valued based on our share price or valued when people are paying for it in the market, a little bit different. It's around $350. So the replacement cost dictates not more of it coming online.
Right.
The amount of retail in Canada has grown by less than 1% over the last 5 years. So there's a supply and demand situation where People want more retail, but people aren't building it. So the people that hold it, if there's that rent gap, can continue to increase rent, right?
What would be the average age of the buildings? Because like,
it's very variable, but yes, like there was a lot of stuff that was built, like a lot of the grocery anchored centers, like in Mississauga or in a lot of like the suburbs, were built when those subdivisions were built.
right.
Right. Because you designed a subdivision, you held up 10 acres, and that's where your grocery store goes. Right. So some of them are 60, 70, 20, 30 years old. And then we've built a lot of stuff that's retail focused in the last 10 years that maybe aren't grocery anchored, but mixed use. That stuff's newer. So the age is all over the place. But because of the value of the asset class, we're constantly improving it, right? Like tenants are going in and out. And when they go in and out, you improve the space, you change the rooftop units, right? You change the roof, you pave the parking lot. So the age of these buildings, because they're generating rent and we're operating them, isn't as much of an issue because you're constantly refreshing.
Yeah. It seems, because I come from a multifamily background, right?
Where age is important.
age is very important. And I know that like for vintage assets, it's like 99% of the stock that we see is 1965, 1975 during the glory days of
absolutely, when the incentives are there, when you can build it for free.
but you're rarely walking inside like a Walmart or something and saying, wow, this is decrepit. Like that doesn't happen. Right. No. So
simpler buildings too. Yeah. Simpler buildings to go up, simpler buildings to build, simpler buildings to maintain. Right. And we've seen that because we're in both asset classes. Right.
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 So where are the biggest, I'm jumping around a little bit, but
no
like, where are you guys looking for opportunities today?
So listen, we always are looking at our bread and butter in terms of what's going on in the retail market for two reasons. One, if there's an opportunity to buy and add value, like we've got a platform, we know what rents should be. We've got relationships. So if we're looking at a center that's on the market and underperforming, I'm like, okay, well, we'll underwrite it aggressively because we can add value. I would say right now, that stuff, because it's in vogue and because, you can buy it at a cap rate and count on growth over a period of time. And there's a spread to the debt, right? Then we're getting outpriced in some of that stuff, right? So we're like, we can't afford to pay that for that. Now, it's a good news too, because that means I've got a comp to take back to my valuations guys and say, okay, we're worth more, right? Because the market's improving. We've had some opportunities lately where I'll give you an example, our prowess in understanding how to redevelop sites and get zonings, along with our operating, excellence in terms of retail, has given us some opportunities. Like we had a long discussion with some private owners of Lawrence Plaza. Great piece of real estate. Everyone knows it in terms of Lawrence and Bathurst. There's a Metro store. It's an institution in the neighborhood. So we bought 50% of that because they wanted us to help them with rezoning. But at the same time, we're now operating it for them. So they're seeing more rental increases. They're seeing some improvement in the quality of tenants.
Right.
We're able to leverage our relationships in terms of the contracts to maintain the site. So those two things allow us to take advantage of that opportunity. Right.
Yeah.
Real. So it's an interesting market right now. Like we're watching everything. We see, like I think I mentioned to you guys before, there's not a lot of stuff that happens, especially in major markets, that we don't see on the retail side. We don't bid on everything, but we're very conscious of what things are selling for, right? Because it tells us what we can afford to buy based on our cost of capital and our debt and everything else, where we can add value. And also, if we're getting outpriced of something because we don't think we can get the rate return over it over a number of years, then it's telling us that stuff we own is worth more.
And in terms of retail transaction velocity, are we rapidly increasing?
There's not a lot. There's a little bit. There's not a lot. It's a tightly held asset class. Like between us and some of our competitors on the REIT side, we own a bunch of it. And then because everyone wants it, once they get it, they hold on to it. Right. So there's been a couple of transactions lately, like one up in Markham for, a pretty ubiquitous grocery anchored center, not even a huge grocery anchored banner, that had all sorts of bidders on it. It had the private equity in there that was looking to buy it at a high cap rate and add value. It had the fund managers in there driving the cap rate down. It had the privates in there. So it was a very deep bid bench. But there's not a lot of that out there. Like a lot of us, especially the brokerage market, has been saying, what's this stuff worth? Because there's not enough transactions to point towards. And then you get you guys know the broker world. Like they're like, oh, just give me one of them and I'll get you like a sub 5 cap. Right. I'm like, yeah. But I would say that I think we'd all be surprised in the market if someone was willing to take a grocery anchored center in a perfect location with great tenancy with some growth opportunity out to market you'd get a deep bid bench.
Yeah.
And there's also some of the institutions and the fund managers who are buying it from not only from a return standpoint, but they're trying to figure out their asset allocation. It's like, I don't have a lot of grocery anchored, I don't have a lot of unenclosed retail, so I need to buy that to balance out. So they're looking at less return and more how they balance out their book, right? Because they might have been deep in malls, they might have been deep in office, but they've never really focused on grocery anchored.
Yeah, it does seem like, I mean, when you think about it, it's like it's often a covered land play, right? Or it can be in long term. It's one of the easiest. Okay, I don't want to make it sound too easy, but I don't know. I've sold my fair share of Tim Hortons, like randomly, because I'm a multifamily guy, but I've sold a few Tim Hortons. What a treat, like everybody gets it. They can tour it. You don't even have to be there. Yeah. It's incredible. Everybody understands what it is. And then particularly, like, you don't get this in multifamily where it's just like triple net, quadruple net. Like, the tenants are paying for everything, taking care of it. Yeah. And that wouldn't be necessarily the way that you guys operate. But
I think it's a good point. Like in multifamily, as you're aware, and we've seen that because we're selling some of our multifamily, you argue about a bunch of stuff. Yeah. Like you're arguing about what the NOI is because it changes every year. Right. And then someone's saying, well, no, you should be paying me for all my vacancy. And you got to be paying me for what I think growth is going to be next year. Yeah. So you're going to argue about NOI a bunch, and then you're going to argue about cap rate. Yeah. Right. And then you're going to argue about what the refinancing rate is. So there's a whole bunch of metrics you're looking at in a multifamily underwriting when you're selling. Listen, there's some of that in retail, but typically you're not arguing about most of the rent. Right. Some of it, the renewal rent and stuff like that, but those are relatively easy data points in the market to go get. Right. Okay. Like what did Tim Hortons renew at this other location? And if you've got a broad portfolio where you're like, we renew 1 million square feet a quarter. So like we're seeing a lot of leases and we're seeing a lot of market and we've got 98% occupancy. So like it's tight. So we can afford to push. So you can see, like where we're getting like, our blended renewal spread is in the high teens, if not on over 20. So like that's a combination of your contractual rent steps and what you're releasing the market at. So how to push and you know what rents are. So underwriting the NOI becomes a lot easier, right? Where we argue is cap rate, and where you argue is, deferred maintenance and CapEx. Yeah. Like, have you put enough money into this building? Oh, the roof is in poor shape. No, it's not. It's fine. Right. Like that stuff goes back and forth. But to your point, it's easier to underwrite, at least my opinion. Yeah. Right? By the way, you just kind of slid that in there. 98% occupancy is insane. And listen, we're at a high mark, but we don't slip much below that. Like even in COVID, I think we were down to 95, 96, right? So, and some of that is on purpose. Some of that is, okay, a tenant's, we're getting rid of a tenant, they're leaving, or unfortunately they've had some problems and they're in bankruptcy and they're leaving. Like we might want to hold the unit vacant for a bit and get the right tenant in. Like we're at 98%, we're focused on tenant quality and growth. We're not focused on filling space.
I guess just talking about the tenant side briefly, like which tenants from your perspective are the strongest or performing the best? And are you seeing any net new tenants come in that you guys are focusing on?
A little bit. I'd say the Canadian tenant market the world is pretty small. Right. I think that's one of the things I would like to see more. I would like to see more tenants coming into the Canadian market. But like the ones that have come in, like gangbusters, have done really well. Now, going back to your first part of your question, the grocery stores in Canada are phenomenal covenants. And they're doing great business and they're competitive. And it's helping our business a ton. We've got great relationships with all of them. But like, and the fundamentals of that business have changed. Like the fact that the Loblaws guys want to do 10,000 square foot no frills now. And they're not worried about parking as much. Like we put a no frills at King and Peter or Queen and Peter at RioCan Hall in 10,000 square feet in an awkward configuration. And they're like, no, we'll do it. I'm like, okay, so now that's a grocery anchored retail center. So that helps us for a variety of reasons. So they're being very aggressive and they've got great covenants and their business models are very robust, right? Related to a grocery anchor, or like the pharma and the drugstores are doing phenomenally well. The banks keep saying they're shrinking their footprint, but we keep doing deals with them, right? So they're great covenants, but even you move over to other stuff, like we've done a ton of deals with Sephora, phenomenal covenant, great operator, great business model, right? Mm-hmm. So leaning more into necessity, that's where we've done well, but even like, we've done a couple deals with Good Life recently, and that's been good too. So the retail, we're focusing on necessity, we're focusing on tenant quality, and we're focusing on covenant, and we're getting rental growth out of those. So it's a bit of a perfect storm for us.
I have a necessity, which is it's very difficult to find a tea time at one of these golf simulators in the winter. Extremely difficult. And so I'm thinking maybe just a smidge more,
I'll take that back to my leasing guys. No problem. No problem. Yeah.
the people need
those
to
guys
golf.
don't always pay the most rent and won't give me a 10-year deal, but and not a lot of growth, but yeah, well, I'll take that back to my leasing guys for sure.
It's amenity
It's
for the other
amenity. Fair
tenants.
enough. I like it.
One thing that we haven't gotten into yet, but I want to take a step back and talk about your career, right? So can you tell us a little bit about how you got into the business, engineering background, right? Like you've been at RioCan for a long time, but
12 years now. Yeah.
Take us into the kind of the early days of your real estate career and how it progressed.
Happy to do it. Listen, I'd say, I'll tell you this, the elevator pitch when someone asked me about my career, but the one thing I'd say before I get into that is I'm a bit of an outlier in terms of my background and my role. I didn't grow up in investment banking. I don't have a finance degree. Some people remind me of that, but essentially I grew up as an engineer. I got an engineering degree. I went and worked as an engineering firm for the first 7 years of my career. And that's where I kind of fell in love with real estate. I did a lot of, commercial development or development in that job. And then eventually got into a position during that 7 years where I was working almost exclusively on commercial development and specifically Walmarts across Canada as they were developing. So spent a lot of time in mostly Western Canada because, Mitch and First Pro or Smart Centers at the time was doing all this stuff in Ontario. So Walmart's working with my firm as an engineering firm to run projects and do deals in Western Canada. So, as someone who's 2 or 3 years out of school, I was flying to Calgary and driving to places like Drumheller and Stettler, which are very small towns in Alberta, and putting up 56,000 square foot Walmarts.
Sweet.
On 8 acres, right? So it was a great way to learn commercial real estate from the development angle. I worked with a real estate manager at Walmart. They'd come in, say, we're looking at these sites, draw me up a site plan, tell me what's going to cost, how long, what are approvals like, which back then was very interesting. You'd go to, you'd meet with the guy at the city who was, the city planner and the dog catcher, and he'd tell you how to do stuff. Very different from trying to get approvals in Toronto. So grew up in commercial real estate there, spent my first 7 years of my career being an engineer. And then that was the boom of big box and retail, right? So you had Walmart building in Canada, you had Home Depot building, and then Lowe's came to Canada, Lowe's Companies Canada, which is the home improvement retailer. They wanted to grow organically. So we pitched them on our services and engineering firm. And instead they just hired me. So I was their third employee in Canada, which was a great experience. Flying back and forth down to North Carolina and, getting accustomed to the American way of doing things was fascinating, but got to do the first 34 stores in Canada with them. So I existed in a kind of a role that was halfway between a real estate director and a construction manager. So they called it a design development director. So I was responsible for helping, inputting on the real estate deal. And I was also responsible for getting the approvals and getting drawings together and then handing it over to a construction manager to build it. So you kind of got to see all the ugly middle parts of how development works.
Right.
And got a lot of exposure to commercial real estate because you understood lease deals and ground lease deals and, purchases and all the kind of conditions that, the deal cadence, you guys know, in terms of LOI, DD, negotiating at waiver, all that kind of stuff. So it was a great learning ground. Spent 7 years there while we were doing those first 34 stores, and then did a couple deals with RioCan. Did 2 deals with RioCan, and got to know the guys there. Lowe's was starting to tail off, looking at buying Rona for the first time. That didn't happen. They bought it the second time, but we weren't doing as much. So RioCan knocked on my door and said, listen, we need someone, we're going to do a little more development. We need someone in our organization that's got a little bit of an engineering know-how. So I went over there to do that. After a couple of years, my mentor there, my boss there, Jordy Robbins, left to be the COO of First Capital. And then they kind of said, okay, you're going to run development now. And had an amazing opportunity where RioCan was leaning in development at the time. So I got to build a whole bunch of stuff in downtown Toronto. Ultimately got to build the Well, which is amazing. Yeah. Went through a period of time where we're spending $500 million a year on development. that's curbed off now for the right reasons. And then as I did that, got the opportunity at RioCan to work a lot with a lot of my colleagues now on the senior management team. Worked a lot with John Gitlin, who's now our CEO, who at the time ran investments. And then when John got tapped to be CEO, he's like, okay, so you know the development stuff. Now I want you to learn all the investment stuff. So put those two together. So now kind of at RioCan, everything we buy, build, or sell is kind of rolls up to me. I've got a really talented team of people, that one guy on the investment side, that's my VP of investments, and another guy on the development side, and a development team. So it's a lot of fun. It's been like I said, it's been a career where passion for real estate is consistent. But the theme is I've always had the opportunity to learn under great people and to work for great organizations.
Yeah. And how many employees does RioCan have right now?
I knew you were going to ask me that question. Around 500, but it depends on, like you got the people on the property management side, and you get people in the office, right? So like we've got just a little, I think under 200 in our Yonge and Eglinton office, which has, a bunch of finance people and then FP&A under our CFO. We've got asset management, leasing, operations, and then investments and development.
Interesting. And by the way, I do think, not to shit on my finance background, but I feel like in years, but I do think finance is easier to learn.
It's been enjoyable to learn. Listen, there's a lot of acronyms in development. There's just many acronyms in finance. So I've learned not to be shy about saying, I don't understand that. Explain it to me. There's no shame in that. That's been a theme in my career. And like I said, I've been very blessed with being able to work with a bunch of amazing people that are very knowledgeable and very happy to, I'm a sponge. I absorb it. I spend a ton of time with my CFO. I spend a ton of time with our CEO. He's a lawyer. Our CFO obviously got a finance background, ex-Brookfield, ex-Enwave. So I learn a ton of stuff from them. So I'm smarter every day.
And so now, can we talk about the moving forward? So where's RioCan going? What is the strategy now? We talked about having a hyper focus on retail, but you guys have a lot of development. Yep. You have a big development pipeline, or you could, right? So, where are we going?
It's a very timely question. So, we had an investor day, I think 3 and a bit years ago, where we talked about our strategy, and we're getting ready, preparing for another one coming up in November. So we're doing a lot of that work right now. So without revealing too much, because I want it to be a little bit of surprise at investor day and stuff like that. Yeah, I shouldn't say that. Surprises are bad in real estate. But at the end of the day, given the current conditions in the market and our, what I can tip our hand to is, like I said, retail is amazing and everyone believes it's amazing now. Whereas, previous parts of my career, nobody did. Yeah. And we're best in class. So we're going to lean into that. We still have a development pipeline. We're going to be choosy about how we spend money on the development pipeline. I love development, but in the context of a REIT, if you're building something that takes 4 years to deliver and you're, putting money in your balance, using money from your balance sheet every year to do it, to get a return at the end of the day, our shareholders and our analysts want to see repetitive returns. They want to see consistent income. That's what we get rewarded for, right? So we're going to be choosy about our development. We still do a ton of commercial development, a pad here, a pad there. And there's some great stories I can tell you about that stuff we've done in the recent history. But the residential stuff, if we build multifamily new, we're going to build it off our balance sheet. We're going to build it with other people's money. We're going to sell the land. We're going to find ways to do it so it's not as cumbersome on our balance sheet going forward. So a lot of leaning into retail. I'd love to find opportunities to buy more of it. The market's got to be in the right spot for us to do it. But in the meantime, our core portfolio can produce a hell of a lot of growth. And we're going to manage it with excellence and deliver that growth to our shareholder, and tell them about it and then deliver on it. And then the theory is get rewarded for it in the stock price.
You guys have a market cap of $5.5 billion or something right now?
Somewhere around that. Yep. And then, enterprise value more when you add the debt in. Yeah. So we're a large entity.
Monstrous.
But it's interesting. Listen, I sit in an executive meeting every week with 8 of my colleagues, right? I'm 7 of my colleagues, 8 with me included. And we talk about the business and we spend 2 hours talking about the business and everyone talks about what's going on in their business. We talk about high level strategy. So I think it's one of the hallmarks of RioCan is, yes, we're big. We don't run it small. but we run it nimble. Like, I think we're very good at responding to what's going on in the market. We're very good at making decisions. When I have people come to organizations from outside organizations who've worked at pension funds or fund managers or any of these kind of things, they're like, well, what are we going to do? I'm like, well, we're going to do some analysis. We're going to take it to a meeting, and then we're going to get a decision. Right. And they're like, really? I'm like, yes, because real estate doesn't move quick, but indecision creates a lot of spin. So you've got to have conviction in what you're doing, do the right work. But we make decisions pretty efficiently,
right?
Which I'm quite proud of.
And that's super, like, speed is one of the main things that I care about.
What kills deals?
Time.
Yeah, exactly. Yeah. So, yeah. Right. Like, now sometimes deals need to be killed because they're the wrong ones, but time kills deals. So you got to have conviction in your real estate. I think you guys had Blair on recently, and I couldn't agree with him more. Like, lean, if you want, like, he's told that story about his brothers and his dad, right? Which is, and I'm not going to retell it because people can go back into your other episodes and listen to it. But at the end of the day, I thought that was great. Like, if you underwrite something and a conviction in it and you believe in it and you know the asset class, then that shouldn't change if nothing changed in the underwriting.
Yeah.
Right.
And just because we do have a lot of, like, agents, we have a lot of owners listening to this podcast. Mm-hmm. Should people call you if they have an opportunity, or somebody on your team who they should be?
Oh, they can call me. Our VP of investments, Z Wong, is also, like, we're tapped into the market, right? Yeah. So anybody who's selling or buying stuff has an inroads to us. If we haven't met them before, that means they probably haven't been in the market that long, and that's fine. But there's not a lot, especially on the primary markets, the top 6 markets in Canada we'll know about. There might be some stuff going on in Lindsay I don't know about because that's not our focus. But, from a retail standpoint, anybody can call me, and call Z, or call the front desk. Well, like, it's our job to know what's going on in the market. I'm happy to talk to brokers what's going on. Yeah. I'm happy, and that's the other thing. I take pride in knowing what a quick no is. Like, no, that's not something we'll do.
Oh my God. I love that. I love that.
And that's about focus, right? Like, yes, we will look at retail. Yes, we'll look at, grocery anchored retail, unenclosed retail. We've only got 3 malls. We're not enclosed retail experts. We like those malls. It's Georgian Mall, Burlington Mall, and Oakville Place.
Right.
But we know enough about retail to manage those malls excellently. So if someone comes to me and says, do you want to buy a mall in Sault Ste. Marie? No, I'm not going to do that. It's a very quick no, right? But if
Great
you
market,
want,
though.
Yeah, absolutely. There's fundamentals in all those markets are getting better, right? But it's not something we currently focus on. Now, if it's a secondary market, like we've got stuff in Kingston, we've got stuff in Sudbury, it's not our bread and butter, but it's still retail and it's unenclosed, and we've got leverage from renting to these tenants in the primary markets. So sometimes we'll be a little more successful in those secondary markets because they're also trying to negotiate something with me at Durham Place, right? Or with our leasing folks. So we'll look at that stuff too.
That's really interesting. Just like the scale of, I guess, your guys' visibility, right? Because you know where this Sephora might want to grow, where, and you can provide that to them. So
listen, I can be in a meeting with our leasing guys, whether it's Oliver Harrison, who are SVP of leasing and customer experience, or even our VP of leasing, Moish, and I can throw a tenant at them. I can throw a tenant, a size, and a location, and they'll tell me what the rent is.
I love it. That's like Ari Gold and Entourage.
And they'll be very confident in it. And almost always they're right. Unless, and then our asset management guys will push them a little bit on it. But, like, at the end of the day, it's a huge advantage we have. We know what the market is because we're in the market leasing these assets, right?
Right.
And if there's uncertainty, we can get the answer pretty quick.
Can we talk about a couple specific? We talked about like, maybe we can chat about that Clarkson opportunity. And I'd love to learn a little bit. Like, we've heard Michael Emery's been on the podcast a couple times. Yep. We had Ty Diamond, who I think Diamond Corp.
We're partners with them. Yeah.
Yeah.
Yep. Done a lot of stuff with Ty, done a lot of stuff with Michael.
Right? Yeah. Haven't had Woodbourne on the podcast yet, but I've been in their office in the Well. It's lights out.
It's very nice, isn't it? Yeah.
It's the nicest office I've been in. But can you maybe start with the Well of how that came together, or how did you guys build out that retail? Because I used to live right around there.
So the Well is a fascinating story. So, I'll give a lot of credit to Michael Emery and Ed Sunshine and Steve Diamond at the time. Mm-hmm. That those 3 were involved in kind of buying that site back in, I believe, 2010, 2011.
Yeah.
And it was the old Globe Mail site, 8 acres. Even then it was like King Street was important, but not as important as it is now. Right. Mm-hmm. So in that neighborhood, right. how often do you get that kind of opportunity in real estate? Kind of like never, right? Like, so able to buy that 8 acres, and then Steve's expertise at the time and currently and still is entitlement with the city. So worked very hard, and I entered the process probably in 2014, 15 when we were still working on the zoning, and worked very closely with Steve's team, who was very talented, to get a really good entitlement where we were able to get like larger floor plates. Like all the residential buildings there are 10,000 square foot floor plates, right? A ton of height, tower separation. So there's 3 million square feet on 8 acres. It's a ton of density,
Crazy.
right?
Yeah.
And then kind of transition into what are we going to build and how are we going to build it? And it was very fortuitous, and in real estate, you got to be, disciplined and lucky. And we were building it during a time when debt was relatively cheap.
Right.
So us and, Steve was there for the entitlement, and then Steve's got a different type of business, right? It's private equity, and, he's not going to build a 3 million square foot development on a balance sheet or even with debt. So Steve exited, a huge part of the process, but we exited him. It was us and Allied, and we built it off our balance sheet.
Yeah.
Which even now I say is kind of nuts, but we did it. And, took some big risks and had a big payoff, right? Like, we had the advantage of being able to pre-lease a bunch of the office.
Yeah.
Because office you can pre-lease when you're going to deliver 7 to 10 years later.
Yeah.
Retail, you can't do that, right? Like retail, you can't pre-lease retail on something that's not built, that's a mixed use concept. So we spent a ton of time understanding what we had to build and what our opportunity was and working on designs. I spent my 40th birthday in England and Europe touring and looking at retail concepts and meeting with architects. So that was fascinating. And then brought that back and hired a really, really strong design team. And then negotiated a couple of construction contracts with both Elliston and Delterra, which are two very different organizations, but worked really well together to deliver it. And hugely proud of what we delivered, right? It's, I think the retail is like nothing else in Canada, and, is continuing to grow and succeed. The residential is some of the best residential, I think, in Canada, both condo and rental.
Yeah.
And, even in this office market, like I tell people a lot of time, like that office building might be the best in Toronto because it's still got 7 years of term left on it, and it's 90% occupied, right?
Yeah.
So right now it's a bond. Over time, it doesn't become a bond. We acknowledge that. But I'm happy it's a bond now, given the office market. So, and the office tenants are thrilled with it. And I think it's true city building. Right. So we've gone through a process of, we built smaller stuff. We were able to build that. Would I build that today based on the fundamentals in the market? No, that's challenging, right? Based on cost of debt and stuff like that. But we had an opportunity to build something amazing, and we're glad we did.
And it is amazing. And just like the retail tenants, because again, I lived like just behind Tip Top at the time. Mm-hmm. And I remember Lauren, who you just met, like, every week something new would open. We're like, oh, Sweat and Tonic, let's go. Okay, they're just opening this spot.
It's an amazing concept. Like, I give those guys a ton of credit. Sweat and Tonic's amazing. And the food hall was like, listen, the whole project was hard. The food hall was as hard as the rest of the project. It was really difficult to execute. You had to pre-lease all that space. We had to deal with a ton of tenants who were great tenants, but maybe hadn't been in that type of space before.
Right.
We had to get all the mechanical systems passed at the same time. We had to figure out occupancy. We had to work with all these guys to get the right equipment in there. So it was I think that part of the whole project showed the power of our organization, but that sub part of that project, that market, we had, a task force that include people from asset management and leasing and operations and development and investments. Like, there was meetings where we focused for 3 hours at a sit on those things, understanding how we were going to structure getting everyone in. Marketing was involved. So I was hugely proud when we opened that food market, because one, I think it's a great offering, but two, it showed that there's not much our organization can't do.
Well, and it was a bunch of smaller tenants as well that you're getting in there. It's not just like a Starbucks and a Harvey's that you're sitting.
That was on their teams too.
It was a good balance of because you do have the Shoppers and Indigo, but then beside that, New York pizza place, which I forget what it's called, but I've waited in that line. Prince Street Pizza, Prince Street, waited for 3 hours with my dog in the cold. Me and Lauren, we're obsessed with pizza. So
you got to go now because we just opened the second phase. So Bear Steak just opened there.
Okay.
From what I've heard, they're selling out at 4:30 every day. They're trying to figure that out, but that's a good thing. So eventually they'll figure that out. And then we opened 3 or 4 new tenants right near the National, which is the bar in the corner there. So listen, I'm hugely proud of that. I was involved in it heavily along with our team, but the entire organization did a ton of work, and I think we should be intensely proud of what we delivered there.
And then let's talk about, we were talking about Clarkson.
Yeah.
I don't know too much about the story, but what happened there?
So just like maybe just an example of, it's a story that's interesting because it incorporates, some of the work we did in entitlement and development, but also what's going on in retail. So, we own 2 assets in the Clarkson neighborhood in Mississauga. So Clarkson Village and Clarkson Crossing. Clarkson Crossing is an unenclosed retail center that has grocery in it, but it's 200,000 square feet. It's a phenomenal center, very productive. It's got a Canadian Tire and a Metro, and a whole bunch of other retail, and it's been phenomenal for us, right?
Yeah.
So whereas Clarkson Village, it's like 60,000 square feet. It used to be grocery anchored, then it had a HomeSense in it. So a number of years ago, when we were looking at entitlements on our portfolio, we're like, okay, well, that's a perfect opportunity to rezone it in a really productive neighborhood in Clarkson and Mississauga, right? So went through a rezoning process a couple times to get more density and ultimately got 500,000 square feet on the thing, right? Like I think 12 stories kind of. So not your huge high rise stuff, and we talked to a bunch of people about it. But at the end of the day, by the time we got all the tenants kind of figured out because that's the other thing about these covered land plays. Everyone wants a covered land play, but until you understand the leases, it's not your site.
Yeah.
Right.
Yeah.
So we lined up all the leases. We got all that figured out. And leasing was not as aggressive in terms of putting long-term tenants in there and getting the best rent because it's set up for redevelopment. One thing led to another, and we're like, okay, we got to move the HomeSense. They've got term. And I think it speaks to our scale and some of our reach is, you're in a 60,000 square foot center. Do you want to go down the street to the most productive node in the neighborhood?
Right.
But that has 200,000 square feet. You want to be in the parking lot in front of Canadian Tire beside a Metro. Yeah, that's a better site. Let's do that. So yes, they had leverage. We negotiated it, but we have the ability we got an entitlement there to put a 24,000 square foot box at Clarkson Crossing. So added to that retail center, made it better, got rid of some tenants that were struggling there and changed them into a HomeSense, which is a TGX brand with amazing covenant, and we'll kill it there.
Sense.
Yeah, and then move them out of Clarkson Crossing, right? So Clarkson Village. So now we've got it. Now we've got all the control. Went and looked at a bunch of opportunities, and this, as the market was kind of curbing on residential opportunities, right? So we didn't really get what we wanted out of it. I'm like, okay, well, we're not getting and then we kind of took a step back, and I'll give credit to our entire team. It wasn't just the folks like me that at the time were focused on development. It's everyone. Leasing's like, maybe we can do one thing led to another. Now we've got a grocery store dropping into that space that we just took HomeSense out of.
Right.
Paying market rents with growth on it. And we've also got a situation where all the other tenants in the center, we can now renegotiate with term and move up. So you went from a covered land play that was focused on development to taking that, great tenant, moving it over to another center you have that's going to make that center better. And now we're going to lean into being a grocery anchored center, right? And we're going to be able to get great growth out of that center. And by the way, that entitlement's still there. It's always going to have 500,000 square feet on it.
Right.
But we might not access it for 10 years. And between now and then, it's going to be a huge driver for our growth in the GTA. So it's just pivoting and understanding both asset classes and not having tunnel vision in that case, and the whole team's awareness of what we're doing and what the best thing for a shareholder is, provided an amazing result, right? Like if you look 3 years ago, we had Clarkson Crossing, which is great, Clarkson Village, which is under redevelopment. Now I have Clarkson Crossing with another 24,000 square feet under the great covenant. And now I have Clarkson Village that's turning into a grocery anchored center that's 60,000 square feet, which is like right down the fairway for anybody who wants to own that asset class, right? You got a 24,000 square foot grocery store. You got 40,000 square foot of CRU. We got a Dollarama in there that's going to pay great rent and grow. And then everything else, we can kind of get market rents and get a lot of growth out of it. So it's a pivot story, right? Like, which is
flexibility, scale, expertise.
And that's what you got to do in this market, right? Like, yeah, I think I listened to the podcast you had with Bader, right? Like very, very disciplined in terms of what they're doing at Center Court and understanding how to buy stuff, but they're not kidding themselves about the market they're in. They know their business and they know what they got to move into. Mm-hmm. So I think in real estate, you've got to be passionate, but very agnostic to what's going on.
Can I ask you, so like, AI is on the front page every single day, whether it's the president of the U.S. talking about it and signing with a Sharpie, or
the Sharpie.
I love that.
The longest signature ever, but anyway.
Yeah. And when you ask industrial guys about it, they talk about data centers and so on, infrastructure, yada, yada. But like, how do you think about AI and how it will impact retail? Like, is there any?
Yeah. Well, I'd say two things. We're spending a lot of time right now with AI in terms of how we do our jobs, right? So Our kind of IT team, led by a guy named Albert's doing a phenomenal job in terms of getting us up to speed on what we should be doing. Because if we're not staying current with how AI can make us more efficient and better at our jobs, then we're going to be behind.
Yeah.
Right. But we got to do it in a disciplined way. So as the organization started almost, I think probably 6 or 8 months ago now, where like I can have Copilot write an email for me. I'll type out an email. I ask Copilot, like, I'm not the most eloquent guy. Like, how can you change this to make it a little better? So that's simple.
Right.
But I think, in a business like ours where there's a ton of information,
Right.
more information than we can manage, to be honest. Right. And in real estate, people go with their gut a lot. Real estate gut is something that everyone talks about, and gut's important because it's based on experience. But given all our data, we're getting closer and closer to being able to access that data at the drop of a hat. So we were like we had a demonstration the other day. We're like, okay, well, we've set it up so we can ask our internal AI kind of, platform, how many leases do we have with this tenant? What's the average rent? When do they all expire? Right.
Right.
I got 32 million square feet. I got 177 properties, right? That's not like if I ask a summer student to ask that question, that's their entire summer, right?
Yeah.
And it's been a challenge because some of these leases, like, yes, we're renewing 1 million square feet a quarter, but some of these leases have been in place for 20 years.
Yeah.
So when that lease was done, it was on a piece of paper in a file.
Yeah.
Now it might be scanned in a PDF, but you can barely read it, right?
Yeah.
It's like reading title. It's like pointless. So we're getting better at understanding how to get all that information and access to it and getting it like 90% right through AI, which helps us be a lot quicker.
Well, and I think soon, I think you could do this now too, but it just has to be organized and you have to check it. But like soon you'll be able to just input, you go, okay, read every single lease that we have, cross-reference the business plans of every, HomeSense, Loblaws, whatever, that we know where they want to grow, and find out where we can move folks, where we're missing opportunities, where we might be able to develop and have some synergies, like exactly like you did at Clarkson.
It's hugely powerful. I don't think for us right now, it replaces, it doesn't, it might, we can get more efficient in our business and stuff like that, but it's not going to replace our thought process in terms of how we think about real estate. It's access to information.
Yeah.
And listen, like I said before, we pride ourselves on making disciplined and quick decisions. But if we have better information, we're going to make better decisions.
Right.
Right. So the key for us now is we've got a ton of data. How do we use the data we have to make an AI to make sure we know what the data is and know what the forecast, but then how do we forecast that out? Right. And we're spending a ton of time in terms of understanding that.
It's so funny with retail because like multifamily is the greatest ever, but most
nice
asset classes, I can paint a bull and a bear case scenario. I guess that's why I'm in brokerage. But like retail, it does seem like no matter which way the market flows, like if even the whole market changed, you're like, okay, well, we have this land, or we sit like it's very difficult for me to think of a bear scenario. So it's you guys are.
So this is great. So I'm going to go back to my office. I'm going to talk to my CEO and CFO, and you're going to come on our next investor meetings. It's great.
I'm happy to.
But I agree. Like the fundamentals are pretty solid.
It's awesome. Particularly the way that you guys do it, where it's necessity based and you've been doing that for a long time.
When you guys have put together, more unique European concept with the well and have been able to be incredibly successful with that, which, nobody's making those types of plays these days.
Yeah. And I think I think that's one of the reasons I'm proud of our organization in terms of doing that. Like, listen, our bread and butter is grocery anchor necessity based. When people thought about us at the well, they thought we were going to drop a Costco and a Walmart in there and we'd be done. Right. But we acknowledged that wasn't the location for that. Real estate is like fundamentally about location. Like is Walmart and Costco going to be successful in King Street West? I don't.
Probably.
Maybe.
Costco,
maybe.
Probably wouldn't be as cool.
But are they going to pay our rents?
Yeah.
So that's the thing. We were disciplined about acknowledging that we couldn't have a grocery store per se down there. We had to have because grocery stores require restrictions, and we had to make a bet. We had to design the retail such that it was going to be flexible when we needed to lease it.
Right.
which is tough, right? Like
over that timeline.
Like you walk that thing, there's a ton of ceiling height. That's on purpose. We didn't want to be in a situation where retailers came in when it was built and say, oh, this is enough ceiling height.
Right.
Because I can't change that. Right.
Right.
Right. We can change demising and everything else. But to your point, we're very good at our core business. But when we have to execute something like the well, we step back, we do a research, and we're thoughtful about it. And then when we have to make a decision, we make one.
Okay. This is a tough one. It's not on any list or anything. Although we have been off script basically the whole time.
Yeah. The list we talked about has been pretty much, it's been great though.
Yeah. Okay. This is a question that we used to do back in the day, but given your long real estate career, all your success, I want to take you to your deathbed.
Yep.
And so, it's your final.
It's inspiring, isn't it?
Yeah. It's your final days, and your family and all the people you love are around you, and you've had this wonderful life. But for whatever reason, everything that you've ever written, every podcast you've ever done, every book, everything has been erased, and you can only give 3 quick bullet points of, lessons on how to live your life, your career, or what have you to pass on. Mm-hmm. What would you put on those bullet points?
Listen, it's going to sound cheesy, but like the most important thing.
Location.
No. I'm not going to give you a canned real estate answer. That's too easy.
This doesn't have to be real estate focused answer either.
Listen, I'm currently blessed with an amazing family. I've got an amazing wife and amazing kids. Like, I'm most proud of being a father and a husband, period. Exclamation mark, done. Like, that sounds cheesy, but I believe that.
And a French bulldog.
Yeah. And we have a French bulldog and a cat. So like, that's what I'm most proud of. The work that my wife and I have done together as a couple and in raising 2 amazing daughters. That's what I'm most proud of. So that's 1, right? You asked for 3, right?
Yeah.
If I look back and think about what I want people to know about who I am is, I'll combine 2 of them is hardworking and have integrity. Right. And I think that's a hallmark of real estate, right? Like you only have one reputation.
Yeah.
That's one of the reasons I love the organization I work in. We've got an amazing reputation, and I'm one of the stewards of that, right? Like, if you say you're going to do a deal, do a deal. If you say you're going to close, you're going to close.
Yeah.
There's nuance around that. I acknowledge that, but like having that integrity and I take a lot of pride in working hard.
Yeah.
Right? There's no replacement for that. And it may sound like an old curmudgeon, but I think that's a bit of a dying quality.
Yes.
Right. I think rolling up your sleeves, learning something, having AI help you with it, that's fine. But really leaning in and saying, okay, I'm going to work my butt off at this when I can, as long as my family is the bigger priority. See the first bullet point, is I'm a huge big fan of working hard and having integrity. And that's why I work where I work, because those are 2 values that are really, really valued at my organization.
And especially if you're a long-term, realistically, if you plan to be in the business for more than like 3 years, you start to realize how small the industry is and how quickly you bump back into people and, oh, this guy's still in the business. Like, it's not going to work if you just screwed somebody over and didn't deliver. So absolutely.
Third thing, give back. I think, whether it's monetarily, if you have the means, or just with your time. My organization is really gracious in the fact that, my CEO is okay with me I sit on the board of Sunnybrook Hospital, and I sit on the board of University of Guelph. So I'm alumni University of Guelph. I got a lot of passion for that place. It made me a lot of who I am. So I love doing that. I spend some time with them and imparting some of my expertise in real estate and whatever else I've learned over my career. And then I'm on the board of Sunnybrook, which I get to work with amazing healthcare professionals that create amazing outcomes with limited means, which inspires me every day. So, but I get to give back to do that. So, family, hard work, integrity, and giving back. Those are the 3 things if you had to write my tombstone, which is really depressing. But if you had to write it, that's what it would be.
But you're not. Yeah. Okay. Andrew Duncan, thank you so much.
Thanks, guys. It was a lot of fun.